there has been a massive entry of retail investors into the Indian stock market. It is estimated that in the last 4 months, as high as 35 lakh retail investors have opened their trade accounts in stock market. This is substantially high compared to the earlier trends. Nothing wrong. In fact, everybody welcomes greater participation from the retail investors. Retail investors like you and me really provide a strength to the stock market and resilience to the stock market. But the problem here is how, as the Sebi chairman pointed out, it is the manner in which these retail investors are coming to the stock market is a matter of concern today. Why is it a concern? Before I explain that, let me first explain why this sudden rush from the retail investor side into the stock market. There are definite reasons for that. The first reason is stock markets have fallen very sharply after Corona and after lockdown. So once they have fallen very sharply, the prices is very attractive. So obviously any low is an opportunity for buying. So the retail investors perhaps are thinking that this is the right time to invest precisely because the shares are available at a very low price due to the deep correction the stock markets have experienced. Number two, the second reason is, well, not just the markets have fallen, providing an opportunity for the new buyers, markets are recovering also very sharply, attracting the new investor. So in the last, if you look at the market trajectory, so there has been a 47% growth from the lows. From the lowest points, there has been a 47% growth. In fact, the stock markets are coming back to the pre-COVID level. So this is the second reason. So obviously when stock markets are recovering sharply, rising sharply, a new investor is attracted into it because he can hope for a greater return. Third, the bank deposits have been unattractive. In our country, historically, the bank deposits attract a lion's share of the household savings, essentially because they're relatively, there's no risk involved in it. They are assured return investment. So, but in the recent past, in the name of economic revival packages, the Reserve Bank of India has been reducing the interest rates again and again. So today the bank interest is almost yielding negative rate of return. That means whatever you are getting in the form of interest, a part of it goes to the tax and a part of it is eaten away by the inflation. So actually there is a negative rate of return. So the bank deposits are very, very unattractive today. That is the third reason. Fourth reason is the real estate is in fact witnessing a very high volatility and people are not ready to buy because people believe that the real estate prices may further fall and they are waiting for a much deeper correction so that the prices will be low. Then the fifth one is the gold prices. Gold is yet another destination for household savings. Gold is now already at a 50,000 and above price and nobody knows what is the trajectory of the gold prices. And there is a fear that gold prices may even witness a sharp correction. Of course, there are also expectations that the gold prices may rise even up to 75,000-80,000. But nobody can know. There is a speculative movement in the gold prices and that warrants any ordinary Indian to invest in the gold market. So then the sixth one is the economic activities are not taking place properly. Nobody would like to invest in their business, to expand their business or to start a new business. So this is not the opportune moment either to invest in the whole business or to launch a new business. So all these six factors have led to the sharp rise in the retail investors into the stock market. But why am I telling it is very dangerous? The reason why I am telling it dangerous is this rise in the stock market, stock prices is not related to any real economy. So it is nothing to do with the economic growth. For example, the stock markets are coming back to the pre-COVID levels. But what is the economy? In the pre-COVID level, economy was expected to grow at a 5 to 6%. Even the last financial year, the economic growth rate was around 4.2%. But today, all rating agencies indicate a negative economic growth. The latest in the series is the ICRA rating agency estimates that the Indian economy may witness a contraction, that is a negative growth rate to the tune of 9 to 10%. So how can the stock prices be same when we have a minus 9 to 10% growth rate when compared to a time when there is at least 5 to 6% growth rate? That itself shows that the stock market do not reflect the real economy. That's the number one. Number two, why did the stock markets fall so drastically? It is essentially because of the massive outflow of the foreign investment. In March alone, there has been a outflow of foreign investment to the tune of 58,000 crores. Today, since May, the net foreign investment flows are actually in positive territory. So that clearly shows that the foreign investment is fueling the growth of stock market. Foreign investors are highly non-reliable. They are unreliable, essentially because foreign investment is often described as the butterfly capital, footloose capital. They are known for their predatory behavior. They just come and go at a very rapid pace. So therefore, foreign investor driven stock market growth story is not a reliable growth story. Third, the prices of stocks do not in any way reflect fundamentals. So the fundamentals are quite different. For example, the price to earning ratio, which is a clear indication of how the stock prices reflect the fundamentals. What do you mean by price to earning ratio? How much a share earns and how much a share values in stock market. So which means the comparison between stock market value of a company and the real value of the company. This is the price to earning ratio. In the Nifty 50, that is the National Stock Exchange index called the Nifty 50. So the average of the last 10 years was 22. So the prices were 22 times the earning. Well, any time the stock market prices will be higher than the earnings because they expect the forward movement in future too. So, but today it is at 29 times, which is certainly overvalued. Stock markets are too hot today and they are overvalued. Any overvaluing will lead to deep correction. Then the fourth one is, what is the kind of investor who is coming into the stock market that is feeling the growth today? It is the real investor is not coming into the stock market to invest and wait for a longer period of time to get the reasonable rate of return. He is essentially entering with a herd psychology and trying to grab the opportunity and run away from the stock market. This kind of an investor will never create a stability here. The retail investor is precisely coming, earlier he was investing in the mutual funds, which are normally relatively less risky and more stable. But due to the fall of stock market, even the mutual funds are yielding negative rate of returns. So therefore, the retail investor is directly investing in the stock market, but the behavior and the mindset of the retail investor is not to stay in the stock market for a longer period of time. He is simply coming to book the profit and leave. So such investor will obviously contribute to the higher volatility in the stock market. So given these factors, it is certainly not advisable for the retail investor to hurry up into the Indian stock market at this point of time.